Hello and welcome to your July Investor Update. I'm Pacome Breton, Head of Portfolio Management here at Nutmeg, and I'll be answering questions on the global inflationary outlook, the latest economic data from the UK and the rest of the world, as well as giving an update on the performance of equity and bond markets in June. How did global financial markets perform during June? Well, June was a good month for equity markets and risk assets in general. We saw strong performance in Japanese equities, helped by a weak yen. And in the US, for the third month in a row, pushed higher by the technological stocks. So overall, most equity markets performed positively, including emerging and continental Europe. However, UK equities were an outlier, and in particular mid-cap stocks performed negatively during the month. It's worth noticing some rather large movements on the currency front, and it's partially explaining some of the outperformance or underperformance of regional equity markets. The euro and the pound performed strongly, pushed higher by the action of the central banks, and the dollar and the yen were generally weak for the month. Government bond markets were overall negative on both sides of the Atlantic, and with renewed concern on the inflation front and the action of central banks. And lastly, corporate bonds performed strongly, in particular high-yield bonds. The Bank of England increased interest rates by 0.5% for the month, while the Federal Reserve decided to pause. How do we interpret those changes? Well, the difference in mood from British and American policymakers was quite striking. And clearly, recent UK inflation data is more problematic than what was seen in other countries. US core inflation came in at 4.6% on a year-on-year basis to May, and the peak figure having been 5.4%, which was reached in September 2022, which is 9 months ago. And in the UK, core inflation came out at 7.1% in the 12 months to May, the highest it's been since the early 90s. So clearly the Bank of England is having a much more difficult task with inflation than other regions. And this is the reason why we've increased our holding of US Treasuries, where inflation seems slightly more under control. Is the latest macroeconomic data pointing toward an increased risk of recession? In a recent survey by Deutsche Bank of among 400 investment professionals, 39% saw a risk of recession in 2023 in the US especially. And the numbers from previous surveys, which were in March, was 64%. And 77% at the end of December last year. So this is clearly in line with what we are seeing on the macroeconomic front. The data has undeniably improved, in the US especially, compared to 6 months ago. However, the UK is in a slightly more difficult situation. The core price rises mentioned previously creates, indirectly, a larger risk of recession. And while the Bank of England will do what it can to manage a soft landing, the task gets increasingly difficult if inflation remains stubbornly high. Further rates rise increases the risk of recession in the UK. So not all regions are equal, and the US seems to be in a better situation at the moment with regards to future growth. Commodity prices have trended lower in 2023 so far, despite overall stubborn inflation. What's the investment team's take on this? Well, firstly, the commodity market is rather diversified. While often driven by common dynamics, each commodity is influenced by its own supply and demand factors. Nevertheless, in terms of global picture, commodities have trended lower compared to peak levels seen last year, and for some, this change has been quite dramatic. So let's start with oil. The price of Brent crude at the time of recording sits around $75 per barrel. This is at a similar level to what was seen at the end of 2021 and largely below levels seen before the 2022 invasion of Ukraine, not even mentioning the peaks reached in the aftermath of the invasion. There can be a number of reasons for the lower price, but the fact that Russia continues to export almost as much as before the war is an important factor. Also, China's consumption remains weak, and combined as well with fears around global growth, it helps to explain the negative trend on oil prices. And the case of metals seems mostly due to the impact of China. The reopening of that economy, which consumes 50% of more of many metals like iron and copper, has had a lower positive impact than anticipated, and especially on external trading. And lastly, gas prices have gone down significantly in Europe and the UK since last summer, but they still remain 2 or 3 times higher than before the Russian invasion. And we also have to factor in that America benefits from a strong comparative advantage in that it has no reliance upon Russian gas, unlike across Europe. As always, thanks for watching. We will continue to keep you updated via regular blogs, the monthly investor update, as well as the view from the investment desk videos. If you have any questions or suggestions for a topic you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments section below this video.